Hi guys, we're back with another episode of What's on Your Mind. I'm joined by Shek and Berggreen this week. Guys, thanks for coming on the show. It's always great to hear from you both. Now, since both of you were on, I think Ed, you were on a couple of months ago, Ben, you were on around a month ago. Since you were both last on, the S&P 500 has kind of continued to hit these new highs, and also quite interestingly, the VIX we're also kind of seeing the VIX at its lowest level since pre-COVID, so since February 2020-ish. So I'm interested in terms of what that means for you guys in terms of portfolio management or maybe trade ideas, and perhaps we'll touch on that, whenever in the episode. But let's kick things off, Ed, with you, if you don't mind, and we'll start with
Yeah,
any equity ideas that you have that might have captured your attention over the last few weeks.
yeah, sure. With regard to the low VIX, thank goodness it's earnings season, right? We've gone from worrying about too fast increases in inflation to too low. We seem to have this desire to have many rotations out of value into growth and cyclicals and vice versa. It appears not much money is leaving the market, or we're just recycling. So I don't think the low VIX is necessarily an issue. However, what it does mean is I'm always looking for more diversification. So I'm quite low conviction from the macro and from a valuation perspective. So I've got this little beauty Tenneco for everyone today. It's a potential turnaround story, auto parts and equipment. Now, this is a large company with a low market cap. It's got 73,000 employees, 300 sites globally. It's got a market cap of $1 billion on revenue 2020 of 15. Basically operates under four divisions. Motor parts, which is original equipment and after brands like Monroe and Walker, that's 18%. It's got its ride performance, which is electronic suspension systems, 14%. Clean air, which is obviously the emission controls, that's 43%. And powertrain, piston rings, cylinder linings, bearings, valves, loads of stuff. I don't really know what they do, but they're very important. That's 25%. They cover light vehicles, trucks, all motorsports, off-highway vehicles, and of course, industrials. The major clients are the major car marques that you would expect: Nissan, Toyota, Ford, GM, Jaguar, Land Rover, Beamer, Daimler, VW, Peugeot, and John Deere and Caterpillar in the industrial space. Now, the thing with the turnaround is you need a bit of history. Tenneco started off life, got spun out of a conglomerate in the late 90s, became Tenneco in 2005, traded steadily and reasonably well, and then in 2018 bought Federal Mogul for $5.5 billion in debt. So the company's got history, it's got some good brands, it's got really cutting edge emission technology. It was one of the first auto parts companies to operate in China. So what went wrong? And really, it was just as usual, a bad deal. It was a heavily convoluted management structure, debt financed. Now that's not a problem as long as the integration goes smoothly, synergies come through, and the P&L moves. Unfortunately, none of those things happened. Another bad negative side effect of that was that they were going to spin out the powertrain part of the business. With conglomerates, not very fashionable these days. There was always a perception that when you spin out some of the divisions, you can create value. This was part of what they were trying to do with the deal. Because the deal was integrated so badly, they couldn't do that. And then, of course, it's just gone downhill from there. So where are we? That's the history. Where are we today? Well, this stock trades on 3.2 times PE, 2.5 times next year. EV to sales 0.3 times. So this is cheap, right? But that doesn't mean it's going to rally. Let's have a look at the revenue. Pre-COVID, 17.5 billion, fell down to 15.5 billion during 2020. It's going to bounce back to pre-2019 levels and growing 4% the year after. So there's nothing in the revenue numbers for you. Just looks like we've had a little COVID recovery, so what? Have a look at the earnings. Earnings, they lost 44 cents in 2020. They're going to make $3.32, so back above 2019 levels. And most importantly, their earnings are expected to grow 30% next year. Okay, so we're seeing really good earnings growth off a pretty unimpressive revenue line. But what that does tell us that we've got really strong sequential EPS momentum, and we like that. When we have a look at the valuation versus the sector's trading on 20 times and Tenneco's at 2.5, 3.5. And the sector trades on about 1 times EV to sales over 3 and a bit times Tenneco. So that's the cheapness relative to itself and its sector. So is this a classic turnaround? Well, we know we've got the EPS momentum. It had a great Q4. What is causing this operational leverage? And we also have to think about what are the issues that really got this stock derated. So it was execution and balance sheet. Well, we can move on to the qualitatives. We can look at the Fed 21 investor presentation, and you can see, most importantly, they've streamlined their management. They've got a single CEO, Brian Kessler. They've strengthened the board, cut out a lot of management, and now it looks properly run. Similarly to a lot of companies, they've obviously looked at their cost, and they've launched this program called Accelerator Plus. They're targeting $265 million of cost savings this year, increasing working capital by 200. As of February, they're already well ahead. Now, if you're running this company, the one thing you're not going to do is overpromise and underdeliver. So I suspect their targets are pretty achievable. And part of this thesis is that they're going to beat. The other most important thing is during 2020, when their revenues went down 12%, they still generated significant cash flow, and they were able to pay off $500 million of debt, moving it down from 5 to 4.5. Now, remember, this company vis-a-vis the sector has debt to capital ratio of over, double. I think it's 1.1 to normally about 0.45 for the sector. So this is highly geared. It's hampering their ability to do other strategic moves. And of course, it's been a big overhang for the derating. They've also managed their balance sheet well. They've rolled their 22 debt out to 29, and their fixed term debt doesn't come due till 23, 24. They've also increased their liquidity by $500 million. Now, turnarounds and catalysts. Obviously, there isn't a specific, but these are the two catalysts that are going to continually have to move to get a re-rating. Now, remember, with the re-rating, we're talking about material margin expansion, with earnings being the same. So for me, although there isn't a single catalyst, the fact that the two things that were crushing this stock are starting to move and accelerate in the right direction, I think is very telling. Time horizon. Now, any of you who have seen Jason McDonald's turnarounds know that the time horizons are hard to call and can be very long. Now, I don't want to trade for a year. I don't want to tie up my capital. So the month I'm going to trade is July, and I'll tell you why. Next earnings are May the 7th. For me, no one looks at a turnaround, unless you get 2 or 3 good quarters. All right, the glass is so half full, not half empty, not half full. So we know we've had a good last quarter earnings. May the 7th, I need to see this acceleration continue. Now, although July won't catch the next set of earnings, I need to see the earnings upgrades coming through. That will mean the trade is still on, the turnaround's playing out, and I might go for longer duration. Excuse me. Price targets. Well, their earnings are expected to be $3.30. I think it's conservative with the cost cutting. You could easily get to $3.60. Now, can you see this stock trade on a P of 6 times? Yeah, of course you can. That's what a re-rating means. So you can get to 21.5 just with earnings coming in 10%, but the market needs to believe that this stock has still got some life left in it. Now, clearly this could go to 8. I mean, if the sector's trading at 20, 5, 6, 7, 8 kind of doesn't really make a difference, but you can easily get to a high 20s price target. Remember, the stock's at 10.5. So structure, I'm afraid it's just by the July 11 strike calls at the moment. You can get on for about $1.25. This stock is at about 10.80, or I think 10.70. It's a low price stock with $1 strike interval, so it's quite hard to do anything unless the stock is trading at a strike. Then you could potentially set up a calendar call. But obviously, because I'm so directionally bullish on this stock, I don't want to do that yet. So we're going to start off with the July 11 strike call. When earnings come out, and if they are good and the stock starts to re-rate and rally, we've then got lots of options. This position, if it works, will mutate into calendar call spreads and eventually a July vertical. So we want the stock to start moving. We might be able to sell a May 15, collect that, sell a June 17, and then end up with the July vertical. Obviously, if the stock goes to 20, you've got an 8 for 1. You're only paying $1.25, they'll be worth 10. Risks to this trade: auto parts is highly cyclical. We know the market's a bit sort of limp about everything at the moment. We're now quite comfortable with inflation staying at these current levels, bit of pressure on cyclical business, but I think earnings are going to sort this out. Obviously, if there's a spike in yields, this company has quite a leveraged balance sheet. So all things being equal, that wouldn't be so good. But the catalysts are in play. I love this. You know, it's hard to get really big payouts when VIX is so low and we're just waiting for earnings. So I like this. It adds diversification. And if this thing does get a re-rating, you've got a big payout.
Awesome.
That's it.
Awesome. Yeah, that sounds very interesting. And like you say, in the current environment, great potential in terms of volatility, which you might not see elsewhere. Okay, Ben, let's go over to you now. Obviously, we just spoke about a long with Ed. Do you have any longs that you've been looking at?
Yeah, so this is a stock that I traded in the past, and it's a product that I use myself. It's this one, GoPro. So I'm, again, bullish on GoPro. I'm going to go over the reasoning here in a little bit. But for those of you who don't know, been living under a rock for the past few years, GoPro sell these little cameras and also wearable kind of camera accessories, and they're also involved in audio and video software. So, but really, it's a company that's focused on kind of the adventure and action sports market, which is growing at a really solid rate. And this is a stock where the founder, Nick Woodman, is still the CEO, which is usually a good thing in these companies. Okay, he started this back in 2004 here in California as a surfer, and he wanted to get some video of him surfing. And it's just kind of, the company has struggled, a bit since, but it's starting to come around. So anyway, it's about a $2 billion market cap company. They went public in 2014 at $24 a share. The stock rallied up to about 100 shortly thereafter, and revenue also basically doubled during that time. So right out of the gate, they're really doing well, but the CapEx really caught up to them. There's a lot of research involved in getting these products to be good enough. So it took a hit in earnings. Also, revenue started struggling, about 6 to 12 months later. And so for the next, from like 2016 all the way until last year, the stock has really had a hard time. Okay, but during that time, the CapEx has been declining actually since 2017 or so, as they're starting to become more efficient and starting to get their expenses under control. CapEx actually peaked at 54 million on a trailing basis. Now it's like 5 million. So it's like they're pretty much their record low. So yeah, so this stock has gone through some rough times. So why do I like this stock now? So what's changed? Well, a couple of things. One is, coming into this summer, I expect to see a surge of people wanting to travel to kind of exotic locations and do exciting stuff. Hike, dive, go sailing, boating, whatever. And a lot of times they want to capture this on video. And yeah, we all have our cell phones, but something that can really handle the abuse that it might take when you're out there, wakeboarding or something. So that's one thing. But really more importantly, though, due to COVID, this company had to pivot their longer term plans and focus more on the direct to consumer market. And they did so by offering, they have been offering a subscription-based service, but they ramped that up quite dramatically and started selling their flagship products at a discount if you sign up for a 1-year subscription. So that kind of changed the business model a bit, and it turns out that it was actually a really good thing. They also consolidated a lot of the retail store exposure to just focus on where the product is selling the best. This was part of their longer term plan, but really COVID kind of kicked this in motion because they just had to, pivot and get something else going. And this is not a spontaneous type of purchase, really. People put quite a bit of research into this product because, it's fairly expensive. It's a bit maybe daunting for somebody who's new to it, but it's actually really easy and simple to use. So all this drives traffic to the website, okay, and strengthen their DTC focus. And I really like this whole subscription-based model going forward. So I'm going to talk a little bit about that because that is really the main catalyst for this trade. So going into the end of last year, they have 761,000 subscribers, which was 145% growth year over year. And they expect to have 1 million halfway through this year and end the year with 2 million subscribers. And they are, they're well on track to do that. And each subscription is $50 a year. So they're going to have $100 million in annual recurring revenue just from the subscriptions. Okay. Not only that, but the subscriptions also has a much higher margin. So it's a 50% operating margins there with a subscription-based business, and that boosts their overall margin expansion from 36 to about 40% this year, and probably beyond. So the whole, for them to get into, focus more on the subscription-based model has really been a lifesaver for this company, and I think can kind of dig them out of this hole they've been in. And the question is obviously, how do you make that stick, right? You have subscribers coming in. Well, you need to make them, stay that way. That's the only way this is going to work. Well, prior to them launching this new model, they already had a more kind of a bare bones subscription model that grew, to 500,000 subscribers just organically with very low turn rates, and they kind of proved the concept. And people kind of want to be part of this, GoPro community where they can share their, videos and pictures and whatnot. Also, it allows subscribers to take advantage of pretty steep discounts for products. And there's actually more to it because they're also increasing their product launches and trying to focus more to, get exposure to a wider audience, not just people who are into like GoPros, but just general people who have, we all have like, hundreds, if not thousands of pictures and videos on our cell phones that we never see again. It just gets lost in the big black hole, of bazillions of videos out there. Well, GoPro is now launching a new app that is really cutting edge and tries to kind of consolidate all this stuff in a meaningful way. And yes, there are other services like that out there, but what GoPro is working on is something else. So that will open up the doors to the crowd beyond just your typical kind of action sports GoPro dude. So by layering, additional services, it's gonna add more personal contact to people, and I also think that it's it's just a better way to leverage the demand for photo and video management if you target customers beyond just the GoPro crowd. A lot of this was from the Morgan Stanley hosted webcast conference with the CEO and the CFO not too long ago. So let's talk a little bit about the financials. Like I mentioned earlier, operating expenses running at pretty much an all-time low. Companies more efficient. They continue to drive innovations. And and the new focus on DTC has really seen massive benefits for cash generation. They actually expect to end this year with $500 million on the balance sheet, which is a company record, by the way. And keeping in mind, some of this, about 20% of that is earmarked for a 2022 convert. But they generated more than 200 million in cash flow from operations in the second half of this last year alone. So that's not really that big of a problem. And also on this webcast, the CFO was talking about potential share buybacks. which, could obviously boost the price if that becomes to fruition. The company has struggled in the past, and the revenue has been pretty volatile. So you can kind of look at this as a turnaround play. As far as earnings and sales, 12-month consensus has risen from 10 cents to 58 cents in just 1 year. So that's quite dramatic. And also forward revenue had a very nice looking kind of upside move and looks to have stabilized. Valuations are reasonable. The forward PE is like 22 and change. Price to sell is like 1.9, which is pretty much in line with its history. They did miss revenue last quarter, but again, the fundamentals for the stock has been notoriously hard to predict. So you kind of take that with a grain of salt. They report on May 6th. Stock has also powered through some major technical levels. Just keep on trying to grind through this overhang. Okay, stock recently punched through the 12 resistance, which is kind of hovering around right now. But it has pretty solid momentum coming off of these very depressed levels. And with these improving fundamentals and the catalyst tailwind, I think this stock can get back up to 17, 18 or so by year end potentially. So as far as the option structure, I did the same as Ed on this one. All right, so pretty basic, just straight up bought July 12 at the money calls at 1.6, no spread yet. This is the type of trade where I could leg into a potential calendar at some point in the future, but right now, just straight up long July 12 calls. So we'll see how that goes. Just throw one more thing in here. I like this company. It is definitely more volatile, so timing is more crucial, and also to give yourself enough time for this thing to actually pan out. And also the small cap Russell 2000 index, have pretty much, well, at least recently peaked. Also the price to sale of the Russell 2000 is now at highest it's been in, almost 20 years. So that's something to consider. So anyway, that's what we got on GoPro.
So just going back to that, the price sales of the Russell 2000, is that in terms of a relative valuation, you mean for GoPro that it could have a lot of room to move?
No, I'm just saying that if the Russell 2000, or basically the small cap space, stalls out at these levels because valuations got ahead of themselves, then that could affect GoPro and other small cap stocks.
I see. Okay, cool. Yeah, I really like that idea, Ben. We've obviously covered a couple of long ideas there. I don't know if that's reflective of kind of overall portfolio views going forward or not. Ed, let's go back to you. What are your thoughts? Have you got any shorts or?
Yes, I have, and I have to. I always have to. I'm running very well diversified, as I've discussed, and that's due to a relatively low conviction on the macro front and on the valuation. So I recently unwound a couple of tech shorts that have played out quite well. But I was looking, we're actually going to short Shopify, or I have. But the reason, my starting point was I do need to have a high valuation tech position that I think is earnings momentum is tailing off, or in fact could go into reverse. But that was my starting point. It wasn't just through crunching Itpm stock screener and going through that way. And the reason why I need a position like this on the book is my basic portfolio is positioned for slow and steady increasing inflation. It's not particularly well positioned for a sudden spike. So I need a short that's going to offer some proper protection and a good payout. So I'm looking for high valuations, low earnings momentum. And what I want to happen is in a spiking rate increase, this stock is going to unwind quite fast. So that was the reason for it. Now, we all know Shopify. It's a quality business, $140 billion market cap. It provides, cloud-based commerce platform for small and medium-sized businesses offering subscription services and merchant solutions. So you ship in their software, and it allows you to run your business, which will be selling across multi-channels, whether it's web and mobile storefronts, physical locations, social media storefronts, whatever. However you're selling, they can give you a singular view, which allows their clients to run products, inventory, order flow, payments, and basically leverage the analytics. So they're really a data collection business. Quick look at the quants. We'll come to the valuation later. Obviously, it was a COVID winner, 86% revenue growth last year, and it's forecast for 38% growth this year and 31% next year. I'm going to come on to what I think will happen with its revenue trajectory later. EPS, obviously, it's gone from making a little bit of money, like 30 cents, 20 cents, to making $3.98 for this year, full year expected. But interestingly, next year's earnings are going to grow by 1%. So their revenue's going from 3 billion to 4 billion. So an extra $1 billion of revenue. Where are the earnings? Now, quickly, when we look at the valuation, price to sales is 32 times, sub-industry is about 8. Price to books 22 times, competitors about 7. EV to sales 46, sub-sector 9. So we know it's rich, but that's fine. That doesn't mean it's going down. However, I'm very interested as to why the earnings are not moving with this extra $1 billion. So the question is, are they really stagnating with valuations at rich levels? So with the deep dive we've got to do is really profitability and margins, okay? When you look through the 2020 numbers, they basically spend 47 cents for every dollar of revenue. Not necessarily a problem. R&D is actually 18 cents out of the 47 cents. So it's 18% of total revenue, and it's growing. Now, they are increasing their investments on product development, Shopify Plus, and cloud infrastructure. But this ongoing R&D expense is pretty much capping their earnings growth for at least a year, possibly longer. On top of this, the company said it's going to spend a further $1 billion developing their new fulfillment network. This is going to impact their margins further still. So not only are earnings going to stop growing at the end of this year, they could be going into reverse. Now, Shopify does make the odd ad hoc acquisition, and that's fine. But another interesting point is all these acquisitions that could fuel potentially earnings growth include a large amount of goodwill. You wouldn't believe it, but half of their long-term assets from deals on the balance sheet currently is goodwill. Now, that's not necessarily a problem, but if you think back to Tenneco, doing a big debt-fueled deal is fine as long as asset prices stay up and the money's there to push the synergies through. So I think they're increasing their research now at a time when inflation could be at an inflection point in a rising rate environment, could put a pressure on the stock. Other reasons to sell, although it's not a direct competitor to Alibaba and Amazon, a lot of their clients are. So there's always that question from their clients' perspective, how much growth can they continue to push through in the current environment? The other point about Shopify is they don't have much of a business presence in Asia. And in the e-commerce world, there's no doubt that the fastest growing region for the next 5 years will be Asia. So to conclude, we're not worried about earnings growth, although I still question whether revenue can come through 38% and 31% in the next 2 years, often increased, obviously, off a higher level, back to pre-pandemic levels. I think that's quite a big ask. I think R&D risk is clearly to the upside. So this stock could start to actually make less money over the next year and a half. And obviously, the valuation is incredibly high. Now, the stock is 20% off the all-time high, not a problem for me. Short interest is incredibly low, 1.8%. I like that. And everyone's bullish, so I like that. So my price target's about 950. Stock's currently about 2020. I'm looking at the July-May calendar ratio spread 2 to 1. Okay, I'm going to buy the July 1200 puts. That'll be $100. I'm going to sell May 1150 puts. I'll get a $45 credit. So be aware, you know, the smallest increment of this trade you can do is a 2 for 1. That will be about 15.5 grand. So it is for the slightly larger accounts. The reason why I'm not selling at the money is if their results, which come out April the 28th, aren't good and the stock starts to sell off, that split in the strikes at least gives me, a bit of a return, maybe 70 or 80%. With these calendar spreads, your path to maximum profitability is very much collecting the credit. Now, I suspect what I really want is the stock to stay above 1150. I'm happy if it does nothing or even rallies from here a little bit, because I need to collect the credit. Then I've got my hedge in place and my book is protected for a spike in inflation, which isn't my base case or the market's base case. But I think this stock fundamentally could just get sold down because its earnings momentum is really slowing down with valuations very, very high. So that's it. Short Shopify.
Yeah, I think Shopify is a really interesting one. Obviously, it's in a kind of secular growth industry, if you like, but it's also somewhat maturing, especially in the kind of Western world, and there's a lot more competition coming into play for them as well over time. Ben, let's go over to you again. Is there anything else that you've been looking at on the equity side?
Yeah, in a market like this, it's always hard to find good shorts when it kind of like rising tide lifts all boats, So it's been a little harder than usual, I think. But anyway, stock that I know quite well is American Airlines. I'm looking at that as a short. I used to be a commercial airline pilot back in the mid 90s. Used to fly heavy 727s and other planes, and I was really into this business. This was, this is what I have a degree in. This is kind of my, really my fundamental background, I guess, way before I started trading. So I know it can be a really brutal business. Okay, it's a tough business. Margins are razor thin. It's really hard to make money in an airline, even on a good day. In a great economy, airlines are struggling massively. And American was really having a hard time way before COVID hit. Okay, so they had, and the biggest problems with the airlines is operating costs. So they had accelerating operating costs eating into their earnings big time for years and years and years. And then you have like bailouts and whatnot. But man, this is a tough industry for sure. I was actually back in the day, I was going to start my own little charter company when I was when I was flying, and you start looking at, and I was a young guy in my mid 20s. Start looking at these costs and these expenses, and it's just insane. Getting clients and getting business is easy; it's not hard at all. But the expenses eat you up. Anyway, this stock has been, banging up again, also against some major resistance at $25, where it really had a pretty sharp pullback. Now, there's a little more to this than that. I have a lot of family in Europe, and Europe is having a really hard time. Obviously we all know the vaccines are delayed over there, so they're still pretty much on lockdown. So if global travel is gonna maybe not be up to speed coming into this summer season, big carriers like American, Delta, United could miss kind of the prime time that they're going to make the most money. That's one thing. The other thing is fuel cost. So a lot of airlines hedge their fuel cost, but hedging is not free. Okay, in fact, a lot of airlines in the past, because their margins are so thin, have gone out of business just from hedging expenses. So American does not hedge fuel cost, and is the biggest impact on the operating expense. And that's fine, right, when fuel cost is pretty stable. But now recently fuel costs have gone up 170% since the COVID low. So that's going to impact the bottom line for American for sure. And so it's kind of the perfect storm, right, for this company right now. Now the lifeline is the stimulus money that's being pumped into the economy. There could be potential windfall for the airlines, including 14 billion in the pandemic relief bill that's kind of earmarked for airlines. So furloughs are now on hold. So it's a Band-Aid, right? My question then is, well, what happens when this Band-Aid is ripped off? they're going to have these airlines with a workforce they can't support and costs that are way out of control. So I find it really hard to imagine this stock going much higher. So that's not the case for a lot of the domestic airline, like Southwest, Alaska Airlines. Those guys are firing on all cylinders because travel is much stronger domestically. Plus, that those guys tend to have a much more focused fleet, so it's easier to manage. But when you have like Americans, American have all kinds of planes to travel all over the place, and it's a complete nightmare to try to manage that in this environment. So I'm looking at, actually I put up this trade just the other day, just as basic counter put spread. I bought the June 23 puts at 2.25, and I legged into sell of the May 20 put at 90 cents. So total spend is $145 per contract. This trade will have unlimited profit potential as long as the stock stays above 20 going into May expiration, and then you keep that premium, and then hopefully the stock fall off the cliff after that. So we'll see how it goes. But so yeah, that's what I have on this one.
Yeah, I like that one as well. I mean, I'm this kind of thesis of international versus domestic travel was really strong. I remember Anthony mentioned that as a sort of idea as well. Probably almost a year ago for slightly different reasons. Obviously, we've got oil volatility, like you said, now coming into play, which is also interesting. Yeah, really good stuff. All right, gents. Well, I think we'll bring it to a close there. It's been a fantastic episode. It's been some great insights, both for myself and, of course, for viewers as well. And speaking of our viewers, for you guys watching, really, I think the main things for you to try and get out these What's on Your Mind episodes is more the process that these guys are going through in terms of how they're building ideas and incorporating it into their portfolios, rather than just trying to copy trade. This isn't trading advice. This won't fit your own trading books necessarily. What we're giving away here in terms of really valuable free content is an insight into professional process. And if you want to build on that and learn how to incorporate this into your own portfolios, then you can buy our courses. You can look at mentoring programs. We've got loads of stuff available for you guys. That brings me to my next point, which is a quick update on Itpm events that are coming up over the next month or so. I think we've got 2 webinars. The first of which is an alumni-only webinar on the 24th of April. That's going to be hosted by Anton Creel and Jason McDonald. The title for that webinar is How to Assess a Company's Capital Structure. So that's gonna build on for you alumni. That's going to build on stuff that you've already potentially learned in one or more of our courses. The second one that we've got is a free webinar for first timers. That is called Reminiscences of a Stock Options Terrorist. And that is hosted by Ed Shek here and Anton Creel. Don't ask me what's going to be in that one, but I'm sure it promises to be very entertaining. That's on the 8th of May for you guys, so make sure you sign up if you're interested. So you guys now know where you can get your next fix of ITPM content, and of course we've got What's on Your Mind continuing on. I think the next one will be in 3 weeks' time or so. So I look forward to that. And we'll see you then.